I guarantee most of you lose money not because you don't know strategy, but because your charts are chaos, looking like Picasso painted it with indicators. Top-down analysis is boring, but this is the exact process that makes me $1,000 a day. When I started trading back in 2015, I thought indicators were a shortcut, but 10 years later, after selling my business and starting fresh, I realized the boring stuff, the top-down analysis, is what separates pros from amateurs. Now, indicators can come in useful, however, use too many of them and your charts become cluttered. What you really need is to rely on price action and focus on both trend and liquidity. Let me explain to you the very simple and boring higher time frame model that I use to make $1,000 a day. You see, once you've found yourself an instrument that trends, that gives you an edge in the market because it already makes it more reliable on the direction price is likely to head next. If you have a bullish instrument such as SP 500, you know that overall we are going to have new highs. It's a bullish index. When we have a bullish market, I want you to look at a daily time frame first of all and plot on the highs and the lows of the most recent dealing range. That's the first step to identifying trend and also where liquidity is resting. You see, liquidity is resting above the highs and below the lows. In a bullish market, you expect the highs to go as a break of structure and continuation. The lows will only go as a sweep of liquidity. But the next thing I use is inefficiency in price or gaps. So if you have a bullish candle which closes with a gap between the previous candle wick and the next candle that hasn't printed yet, you can expect price to come back to fill that gap before then continuing to break new highs. Take this piece of price action on ES. This is a daily chart. We can see that we are in a bullish trend. Price is creating higher highs and higher lows. Let's mark out the dealing range using a GAN box, and we can see this is our dealing range. If we look at the candlesticks on the bearish move down, price is very efficient. We have wicks at the top. This body was filled by the previous candle, and the next candle has already been filled by this reverse bullish closure. Then we look at the bullish move immediately, and we can see that price here is also very efficient. So what do we expect? We expect external range liquidity to be the draw on price. So we play this forward, and as it's a bullish market, we would expect, of course, the highs to go, which they are. Now, let's rein this in. We've identified a break of structure, but we don't want to be buying on a breakout of a higher time frame, especially in all-time high territory. We want to wait for a reaction and then buy once we've had that reaction. So what's a great way of spotting using higher time frame liquidity where that reaction is going to be exhausted? Well, if we look at the previous daily candle, there is a gap between the previous wick and the current daily close. This is price inefficiency, where price likes to come back and at least mitigate, but often fill the whole gap to become efficient. So we can sell into this area knowing that price is going to react at a all-time high structural point and then become efficient before then expecting, now that price is efficient, to continue to the upside. So price has now filled this gap, and in the process, what it's done is it's created a new daily dealing range with a new structural high to target, and more an immediate target. This current bearish candle has created inefficiency in itself. So of course, we're going to go down to a 4-hour and a 15-minute to refine before looking at an entry. But for higher time frame bias, we can now expect price to turn around and target this immediate liquidity, just like it did. We repeat the process. Now that this gap has been filled, we look at this most recent move, which is a bullish impulsive move that has in the process left behind inefficient pricing. Because we have this inefficiency, we expect this inefficiency to be filled first before external range liquidity. So we play price forwards, and we can see price is coming back to mitigate and fill this inefficiency, and then it goes on to create all-time highs. We can use this same process not only on the daily time frame, but we can refine it down to a 4-hour time frame, which then gives us our bias for that set trading day. But there's one more higher time frame piece of liquidity that I want to show you, and that's utilizing the previous weekly candle. So we can look here at a weekly close. We can put a line below the weekly low, expecting this at some point, just like a prior week, has been taken, swept, and then to break structure. It's not going to happen all the time. However, when we are seeing deep retracements on a 4-hour daily time frame and the weekly candle's fairly small, we can look at that as a draw on liquidity, come back to a daily or a 4-hour and wait for price to draw into that. Now we have an area that we can look for reversals on a lower time frame and look to trade following trend. We now have a new dealing range, a new structural high. Price is very efficient on the daily, but now let's look at the 4-hour to see if we have any inefficiencies and how we can utilize this to our advantage to take buying opportunities in a bullish market. So first things first, let's map on our higher time frame dealing range. We've broken structural highs, we've retraced, we've come into discount of the dealing range, we've taken the previous weekly lows. Price is very efficient in this last bullish move, and we've had a bearish leg down, which we now want to look at draws on liquidity. So if we start from where we are in current price action, we edge back, we can see there is a 4-hour gap resting right here. There is another 4-hour gap resting above here, and there is one more 4-hour gap resting above here. So we have 3 immediate levels of liquidity before price even reaches the all-time high and the external structural high. So now all we need is our 15-minute confirmation to take buys into this. The 4-hour is already set up. Let's go down to a 15-minute, and we want to be focusing on the New York trading session as that's where most of the volume lies in the US stock market. So let's play this forwards. This is the Asia session. We then move into the London session where price continues to trade into this 4-hour gap. As New York comes back, and we expect it to pull back, because if you've watched one of my videos before, you'll understand about session-based liquidity. London session is here, and it's not taken any liquidity below Asia. So New York is likely to come back and take liquidity resting below London. So a late New York session continuation would look something like this. Wait for that 15-minute retrace candle after price has taken London session lows. We still have some gap to fill, but even if you were to say this gap's being filled, remember we have another gap resting above. So we can either target the opposing side session-based liquidity of that trading day of trading futures. So if you're trading futures and you need to terminate your orders before the end of the trading day, that's fine, you can do that. If you have a swing account, if you're trading a personal account or a swing CFD prop firm account, you could target the nearest 4-hour gap, the next 4-hour gap, or even the higher time frame structural highs and just trail your stop beneath or keep the stops at break even and see how much you can edge out of this bullish market. But for the purpose of this video, let's keep it at a strict 2-to-1 and let's see how this trade plays out. There we go. Very quick TP. It does consolidate for about an hour, but then you're in and out of that position within 1.5 hours. Let's jump back up to the 4-hour time frame, and we can see the only thing that's changed is that price is drawn into this 4-hour gap. It's starting to create efficiency in this bearish leg. That's what we are looking at. Next level of liquidity is here. So we can expect 15-minute pullbacks during Asia, London, or overnight, but then continuations during New York session into this higher time frame draw on liquidity. And we want to be targeting these areas, especially trading futures, because you can't hold overnight or for days, but knowing that we have solid targets along the way towards breaking new structural highs. It makes sense. Jump back down to a 15-minute and let's play this overnight. Asia session, London session. Now we can see here that Asia session and London session both consolidate. It's not taken any liquidity. So we can expect New York session to continue slightly, but come back and take some kind of liquidity, ideally London lows, maybe even the lows of the entire session. But this is my expectation. This is my entry model. Go back and look at my prior 10, 15 YouTube videos, and you'll see the same thing over and over again. So let's wait for session-based liquidity to be taken. There we go. There's your run on liquidity, which ends up taking London session lows. A retrace candle, we put our positions on. We expect price to travel straight through this immediate draw on liquidity, and we can target the next 4-hour gap or a straight 2-to-1 again. And there we have it. Within a 4-hour period, we're in and out of the market. We're in and out before futures market closes for the day, and another 2-to-1. And price goes on and actually reaches the next 4-hour gap and even fills it. Notice how price also immediately reacts as soon as it's filled that. We can expect to see the next consolidation, and we can see the next position exactly what we expect, a retracement. It's spilling any inefficiencies along the way. We can see that this bullish move has created inefficiency in itself. So this is now the next day draw on liquidity, expecting the pullback. We have an actual logical mechanical reasoning behind lower prices before we then target the next higher time frame drawn liquidity, which are the all-time structural highs, now that we've created efficiency on the way up using gaps on this bearish leg. So let's play this forward, jump back down to a 15-minute time frame. This is the expectation of price today because we have that 4-hour gap that's left behind. We also expect a retracement after filling out such inefficiencies. And actually, first of all, what it does is it takes that structural high, even better. So now we've taken this structural high, which is all-time high. Anyone trading SP 500 is obviously going through this a lot. So now we can expect a reaction, just like we expect reactions each time it takes a structural high, like so. Takes a structural high, reaction. Takes a structural high, we now expect another reaction. So we can look at, first of all, the daily time frame and have a look at any inefficiencies here. We're just going to have to play this candle back because it's finished that day. But we can see we have inefficiency in the previous daily candle. Go back to the 4-hour, play this forwards. So the daily candle has a 4-hour gap resting inside of that, and then price immediately runs into it. It not only runs into the gap, but we also have a 4-hour external range low resting behind. And those that have been following me for the last 3-4 years will know that I love 4-hour range liquidity. I used to draw boxes like this and to show 4-hour trend. I just don't draw the boxes anymore. I'm still trading the same way, but I know where it is. It's a low and a high. You don't have to be drawing boxes for the rest of your life. I don't predict the future. I just listen to what the market's already telling me. And by the way, this is just a small part of the process I use every single day. If you actually want me to walk you through it step by step, the same boring system that pays me on average 20K a month, I'll drop a link below the video so you can learn more. But for now, let's keep going and get into how I refine this on the 15-minute time frame. So daily gaps filled, 4-hour gaps filled, 4-hour external range low liquidity is met. And not only that, but that bearish move has done what? It's left inefficiency behind, which is the new immediate target for price. We're not expecting to come and take all-time structural highs yet. We have an immediate target right here. What time of day did it take this? Let's go back and we can see, played it out for us already, but New York session drove straight in to this 4-hour external range low, filled daily and 4-hour gap, gave a retrace candle, and a 2-to-1 was met before the end of the trading day, before price goes and continues and fills that 4-hour gap once more. Let's have a look and see if we can see one more opportunity. There's actually a loss in here, so I want to show you this. So let's go back to the 4-hour. Price is now very efficient. So this is an area where we want to be marking out our dealing range, and the only obvious target is the external range low for a sweep. We've just taken 4-hour liquidity, so that's unlikely to happen, or the external range high, because price within this is very efficient. It's efficient on the daily, it's efficient on the weekly, it's efficient on the 4-hour. So let's jog down to a 15-minute, and this is where we want to be more aggressive and looking for continuations, hence taking a loss before then a win. So price has filled that 4-hour gap. Let's rain this out of the way. The only target that we have in place is this higher time frame high here. We see so much opportunity with this trading model. So let's mark out the consolidation during Asia and London, very similar to the few days earlier. So we can expect New York possibly fake out, come and take London lows or even Asia lows, because if London has not swept Asia, New York is very likely to come back and take that external range liquidity. And I want to show you both of these. Even if you wouldn't take the London low, I'm still going to show it on there because losses do happen, guys. Right. So we've taken London lows already, but this is pre-New York. This is too early. Play this forwards. New York session's now kicked in. You now have a new low of the New York cross. If I put my session indicator on, we can see between the London and the New York crossover, we can mark out the lowest point and the highest point, and that's session-based liquidity. So that's swept. We have a retrace candle. We can get involved in that and expect price to continue. And it looks good so far. It gets to about 1-to-1 before fully retracing. I would not have had likely my risk off at 1-to-1. It's usually about 1.5 to 2-to-1 where I'd trail my stop to break even. So let's call this one a loss. I already know because we have the position on here, but the trade idea has remained the same. Why? Because the daily is the same. The 4-hour is the same. Price is efficient. Our trend is still bullish. We have our overall target as the structural highs up here. We want to get in and out 2-to-1, right? We're still consolidating. We've basically chopped out, induced early buyers. Maybe this position we are induced by that early buy signal, but price is coming back. We still have Asia lows to take. And quite often I'll trade 1 or 2 hours after New York sessions close for me, which is only 7 p.m. UK time, is a lot earlier for you in the US. we have that retrace candle, and we can either take a 1-to-1 and claw back the loss, or if we have enough time in the day, depending on what futures firm you're trading, you might need to get out around 7 p.m. to 9 p.m. UK time. Let's play that forwards. Slight retracement before price comes in and gives you a 1-to-1 before you would likely on a futures account need to close your position. If you're on a swing account, you could probably hold this overnight, and your immediate target would be the opposing buy-side liquidity of the trading session, which is met. So there's your 2-to-1. If you're trading this on a personal account or a CFD firm, or if you want to go for a larger risk to reward, a 5-to-1, maybe a 4.5, I would have my stops slightly larger, and then you might be able to stay in this position. Stops would likely be at break even. So you might take a break even on this before then taking another position, which goes on to TP at the opposing side session-based liquidity of the day also. Same exact entry model. London doesn't take liquidity during Asia, so expect New York to come back and take Asia lows. It did. It also happened to take this low, which is what is a 4-hour low, guys. 4-hour low is swept, right? Price is very efficient. There's no gaps. Sweeps the low that's generated, and then it goes on to take the highs, like so. Again, futures position, 2-to-1, opposing buy side, session-based liquidity, close before the end of the trading day, or swing trading, target the highs. Break even on this one, only to take a 3.5, 4-to-1 on this one. So you want to use your weekly for weekly highs and lows of the previous trading weeks. You want to look for a bullish market, ideally a trending market. You want to look at daily highs and lows and daily gaps for price inefficiencies for immediate price target. Refine and do the same thing on the 4-hour highs and lows. You know what your structural daily range looks like. You can look for 4-hour gaps that aren't present on the daily that price can immediately target. And then for your entry model, look at session-based liquidity. Look at how London performed out of Asia based on that 4-hour and daily draws on liquidity and immediate session-based opposing side liquidity for trading futures. I know what it feels like to waste years stuck at break even, chasing indicators and often doubting yourself. But once I committed to this boring top-down process, it completely transformed my trading. Now I pull my money out of the markets every month, 20K, 30K, sometimes even more. In April, I did $121,000 with zero hesitation or stress. If you're ready to stop guessing and finally become the consistent trader you know you can be, click on the link below the video, and inside I'll walk you through this exact system step by step, the same way that I've helped other traders go from confused to consistently profitable. You don't need more excitement in your trading. You need boring. You need structure. And if you follow this, your transformation starts today.